Hello and welcome back to the Wendell Effect. My name is Brandon Wendell, obviously, and I'm here to guide you through my view of the markets for the upcoming week. I'm recording this on June 5th, so we're halfway through the year already for 2022. It's kind of crazy. It seems like it's just flying by all of a sudden. So anyway, we're going to go ahead and kick through this and go ahead and move on. And whoops, sorry, just hit the wrong button there. Let me just go ahead and fix this, shrink myself down. And we will take a look and remind you that we are not registered broker-dealers or investment advisors. We're going to take a look at these markets from an educational standpoint only. I'm not telling you to buy, sell, or hold any particular securities or telling you to, again, not giving you personalized recommendations. All trading does involve risk of loss. This is always a situation no matter what we do. We can't eliminate the risk. We can only manage it. And we're not subject to trading restrictions either. We can have a position in a security or initiate one at any time. So that being said, let me go ahead and move this on and just remind you that if you want to stay in touch with us, email us at the Wendell Effect at tradingmindsetassociation.com. You can also search me out on Twitter at TraderBW. You can contact me there as well. Obviously, we're on YouTube at the Wendell Effect and also our website, tradingmindsetassociation.com. Also want to let you know, coming up on June 21st, later this month, I'm going to do a live session. So about an hour before the markets open in the U.S., I'm going to do it at 8:30 in the morning Eastern on June 21st, live session. So it'll be opportunity for you to get your questions answered in a live market environment. I'll take a look at what's going on in the markets, do some day trading opportunities as well as some longer term swing trades. So it should be a lot of fun. Also today, I've got a special interview with an old friend of mine, Dan Sugar. So I'm going to talk to him in just a little bit. You'll see that towards the end of the video. He's a third generation floor trader. So unfortunately, the floor is no more, but he was a third generation floor trader in Chicago. So we'll talk a little bit more about that and visit with him. Anyway, so moving on for today, the schedule, number one, I'm doing my weekly market analysis as normal. We've got the equity index futures, then moving on to the energy markets. Then I will jump into sector analysis with some stock opportunities as well that I've identified. And then we're going to go ahead and jump into that special guest, as I mentioned, Mr. Dan Sugar. So jumping right into it, let's take a look, see what's going on in the equity markets, the equity index futures for the week of June 5th. And looking at the ES, basically we've done a retracement of about 50% of our most recent impulse down. It looks as though last week we started turning red once again, so we're seeing the sell-off resume. The bear market's not over. I think that last week was just a small pullback, and we're going to continue to see more selling pressure in the long run. We have not gone more than about 21%. I think it was a little under 21%. From high to low for the year of 2022. And I think we're going to go much, much further. I think we will go into recession and we should see about a 50% retracement off those highs from the beginning of the year. So as you can see, we're waiting for confirmation now. We've got that indecision candle. If we break the low of that candle, look out below, we're heading down. So we got no momentum anyway. You can see we had that divergence on the daily chart that led to the retracement or correction, just as predicted. And then we made this high in the high in price, but you notice the RSI never made it into bullish territory. Well, that obviously is a very bearish sign for the markets. The fact that we couldn't move into bullish territory whatsoever means that we're going to continue the bearishness long term. And it looks like it's going to start this week. Okay, you can see we've got a pullback there. We just couldn't get into bullish territory. Even on the 4-hour chart, we're making some lower highs right now. We just need to make the lower low to kick off the resumed selling pressure. Now, we paused just shy of this demand zone at 40.65. I think we're going to beat that, push right through it this week, and maybe end up somewhere around that 39.8650 area of demand. So I see us maybe bouncing that on about Thursday, perhaps, and then getting a little bit of buying pressure going into Friday before we sell off again next week. On the NASDAQ, you can see we pulled back about 38%. So we had a lower retracement value. The S&P retraced, I think it was about 50%, while the NASDAQ only retraced about 38%. So a much weaker retracement. There's more selling pressure in the NASDAQ, and it's getting ready to continue to the downside again. You look at the daily chart, you see that 38% retracement that we tested and are just pushing down now. There's a little bit of underlying bullishness, but overall, I don't see us going very far to the upside. I think we've done all we're going to do and should continue to move down. Oops, sorry, went too far there. On the 4-hour time frame, we got a bit of divergence. As you can see, we've got the higher highs in price, but we don't have the momentum to sustain that. Sorry, I'm just checking to see what my dogs are doing here. Okay. Anyway, as you can see, lots of weakness. Now, what we need to see is if we're going to break down and make fresh lows, we need to see the RSI go below 40. If it doesn't, if we stay with the RSI above 40, then as we come to that demand, we should be able to bounce. But if we're breaking 40 to the downside, then expect the demand not to hold, and we should keep going lower. And that should actually say NASDAQ, not ES. I apologize for that. We looked at this last week or even the week before, and we saw that Apple and Microsoft are the two main players that really drive price when it comes to the NASDAQ. So continuing with that, we can still see, even though Apple had retraced a little bit, it never went into bullish territory. You can see we couldn't get above 60. We barely got above 50. That's extremely bearish for Apple. And what's bearish for Apple is bearish for the NASDAQ. It's going to influence that index and cause it to drive downwards this week as we resume the bearish trend. We actually started making lower highs and lower lows. So already starting to see that weakness, and we should be able to take out these prior lows going into this week. Microsoft is pretty much the same picture. It's a little bit more bullish, but not by much. Still see lots of bearish pressure on Microsoft, and that's going to cause the NASDAQ to drop as well. The Dow was a bit more bullish, trying to hold up better than the other indexes, but ultimately it's still bearish. So you can see we actually retraced 61.8% of the impulse down from March, April, May. But just because we had a little bit more bullishness doesn't mean that this is something you want to buy. The overall markets, our equity markets, are very, very bearish, and we're likely to continue to see that selling pressure. It's just going to take a little time for it to resume. And we may end up going a little sideways here in the Dow this week. Sideways to bearish. You can see on the daily chart, 3 out of 5 days last week were red. They were bearish. So definitely seeing weakness. Actually, I'm sorry, it was a holiday, so it was actually 3 out of 4 days to the downside. So overall, very, very weak, very, very bearish. And this was the strong index. So overall, this is, again, just showing us that we're likely to continue to move down. And that should, again, be the YM, not the ES on the 240. Apologize for the mislabeling there, but I'm telling you what it is. So on the 4-hour YM chart, we're seeing drop in momentum as we're getting lower highs and lower lows. So we're getting more bearish momentum picking up. What we need to see if it's going to continue to go down freely. If we break this low, we really want to see the RSI below 40, and that'll give us more confirmation to the downside. But this has been the lagging index as we move lower. The NASDAQ's the better short. Same thing with the Russell. Now, the Russell did a 50% retracement, as you can see on the weekly chart. We had the impulse down, a little bit of correction, but still extremely bearish. We barely even got back above 40. So this is a very weak index altogether on the weekly chart of the Russell. Moving to the daily chart, you can see same thing, very, very weak. Making similar highs, but again, very weak altogether in the RSI. So we'll see if this ends up snapping the uptrend and starts coming back down. It does look like it wants to this week. I'm expecting more bearishness. And on the 4-hour chart, I finally labeled that correctly. You can see that we came up towards the area of supply. Should have tried to break through, but since we saw lots of weakness, it just didn't happen. So we were kind of caught in a sideways channel. We tested this area of demand, actually violated it slightly and couldn't make a new high, even though we had a little bit of bullish pressure coming in. A fly trying to, whatever that was, bug. Anyway, it looks as though we should be able to drop down. We made a lower high. If we make the lower low, we should test 1806 before the end of the week. Moving on to the energy markets. Now we've seen the equity markets. Let's take a look at what's going on there. They've been pretty bullish, especially crude oil. You can see that we've broken out to all-time highs once again. Looking at last week. Now the one issue that I see is even though we've broken into some new highs, we didn't do it with the momentum. So that's weak. If you get new highs in price, you should be seeing more momentum, not less. So that's a warning sign that we may get some sort of a pullback pretty soon. Just got to watch for it. We broke out of this ascending wedge or triangle that you see here, and we broke into the upside very, very strongly. We went above 60 on the RSI. Overall, very bullish. Wait for pullbacks and retests to be able to go long. I wouldn't be surprised if they didn't mark it off at this 110. We have kind of rally, base, rally. We could possibly tag that again. We kind of already did once, but we could do it again and take off from that area. But I'm going to be looking for buying opportunities on the pullbacks. Notice on the 4-hour time frame, we had an inverted head and shoulders here, and we've already broken out of the neckline. I would not be surprised to see us pull back again and retest the neckline around 117.50. That would be a buying opportunity at that point. So a lot of times when you get these breakouts of formations, you get a pullback first before you continue on to the measured move or the target. So I'm going to be a buyer. If we can pull back to 117.50 on that inverted head and shoulders, maybe place a stop below the low here, wherever that is, right around 115.25, and then target 124.17. So that looks like it still might be a good opportunity if we get the pullback. And if we don't, so be it. We just miss out. So moving on to nat gas, very strong as you can see. Momentum, however, is dying. Okay, not to be surprised. I mean, we had a pretty good move, but usually retrace after some point. Moving into the daily time frame, you can see we are just pulling back a little bit, a little consolidation in price, lack of momentum. Just taking a breather. It's not a big deal. You know, we did make a new high, but couldn't do it with the indicator, with the momentum, so that's why we pulled back a little bit. Moving into the 4-hour chart, you can just see the momentum's dying. We're kind of caught in a little bit of a downward channel, or even sideways you can mark it. So we're likely to just go a little bit sideways for a bit before we break and continue the move to the upside. That's what I'm seeing. Looking at the weekly chart of gasoline, same picture. We're almost actually made the measured move. You can see we stalled out the first measured move of 0.618, and now we made it to the 100% duplication of the prior impulse, yet again stalling out. So not really much of a surprise there. You can see we paused at this fib level. We paused at the next fib extension level. We should be pausing when we get to the next level. As of right now, we've got some indecision on the daily chart with that doji. But if we break the high of that doji, we'll continue on to the target of 4.4456 before we retreat once again. There's plenty of momentum there to continue to go higher. So on smaller time frames, 4 hours or less, I'd look for buying opportunities on pullbacks to demand and target 4.4456. So looking at this 4-hour time frame, we actually do have a little bit of demand below. You can see we've got drop, base, and rally at 3.9098 to 3.9598. So wait to see if we can pull back to that area of demand. You might also mark this one as demand too. You got drop, base, 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 and rally. That's pretty good. And let's see what that is. It's the 240 on gasoline. So let me go to my live chart here. Using the July contract, 240, there we are. And I just want to get the right numbers here. So there it is. And we're looking at about 4.0504, 3.99 basically. And this one's not really a good zone, so we'll ignore that. But this is what I'd look for a buy opportunity, as I said, at the 4.0504. And I don't have the overhead target in there anymore, but it was 4.4456 as the target. Okay, so that's what I'm seeing so far on gasoline. Moving to heating oil, same picture. We got the move to the upside, but momentum is dying off. And with that lack of momentum, we got to have some sort of a pullback pretty soon. On the daily chart, you're seeing the lack of momentum with the topping tails as well as the indecision right here. So it's hesitantly moving higher, but we should get a pullback at some point. Looking at the daily chart, you can see we did hit our first target at 61.8% extension and retraced. We're now on our move up for the next leg, trying to reach up to 4.5107, the next measured move. So again, if we got some opportunities to buy on the pullbacks, you want to do that till you hit the target of 4.51. Anyway, we'll move over to the stock markets and looking at the stock rotation as well as the sectors to see who's leading us. We still see lots of rallying going on. This is the last 6 months' performance, and energy is still leading us to the upside. It's very inflationary, not really surprised, and it's usually near the peak of the stock market. You see that. We haven't really had the rush to safety yet. That rush to safety would be seeing staples, healthcare, and utilities leading. So if we drop this down now from the 6 month to the last month in price action, we see that energy is up 14% in the last month, and you got utilities, believe it or not, also benefiting. Looking at small picture here, the last week, so we went from 6 months to 1 month to now 1 week. In the last week, the only positive sector really was energy, and a little bit on industrials, but not much. Everything else is pretty weak, including healthcare dropping 3.13%. So kind of a weird market, just everything kind of selling off right now. No real flight to safety whatsoever. So looking at that, we can dive into energy. You see energy, again, was the strong sector. This is for last week and just watching the map. So looking at the XLE, we even gapped up and dropped, but then basically wiped out all the selling pressure that came in. So underlying bullish pressure still, but I'm worried because you see the momentum's not there. So even though we tried to recoup all of our losses we took on Tuesday, it looks as though we did recoup most of them, but this is not very strong. So there might be another pullback coming pretty soon. So looking at the hourly chart, BKR, or Baker Hughes, I had this as a buy opportunity, and it actually did pull back. This is on the hourly time frame, so hopefully you guys were able to take advantage of that. But I had picked this as a buy opportunity. Prices did retrace right at the end of May, beginning of June. You could see we came into that area of demand that I mentioned, and we almost hit target 1. We haven't hit target 2 yet, not even close. So we're just barely touching target 1 at this point. There's still more room to the upside to go. I would look possibly even on a 15-minute chart to see if there's any kind of demand areas that you can buy on a pullback. ESTE, this was on a 4-hour time frame, and I went down to the 1 hour. You can see there's still an opportunity to buy here. We never came down into the demand zone, so it looks as though there's still a possible buying opportunity here. 1960, 1923 on the hourly, with target 1, 2166, target 2, 2293. SM Energy Company, we have a bullish trade that I was identifying. It still has not pulled back. Still waiting for it to come back to our area of demand. We got nothing but bullish pressure here on this 4-hour time frame. So waiting for the pullback to get in. And we'll just see. This may be a new zone forming. We have rally, base, rally. So my name, we get back to the original move and just have to use this 46 as a possible long opportunity. So you can see that dropping down, this was on the 4-hour time frame. Looking at the 1 hour, it really didn't go anywhere. Didn't even get down to that 46. You can see that zone right there. Just went sideways. So keep an eye out for that. CLR was another 4-hour trade I was looking at, and we were looking at a demand zone at 65 and 66, as well as down here 61. So that was what we were looking for. As far as the trade, it didn't go anywhere. It didn't pull back far enough to enter the trade. You can see this is what it looked like when I was putting out the trade last week. And since then, we really haven't gone anywhere. We had a little bit of a gap up, pulled back, but never triggered an entry. So we could possibly still watch this and see if it's going to pull back anymore and give us another opportunity to get in. Oops, sorry about that. Okay. And moving over to the utilities, you see XLU on the daily chart just kind of weakening a little bit. We tried to rally up again, couldn't make new highs, just seeing kind of weakness here in utilities. Overall, they were bullish for the week, but just barely. You can see that we had a kind of a move up. I think it was the end of last week, and then this week we really didn't go anywhere. So it was showing a little negative. Oops, what's happened there? NRG was another trade opportunity I was looking at last week. You can see that hasn't gone anywhere, unfortunately. So no opportunity, never pulled back to get us in. So just got to kind of throw that one out. It never happened. No big deal. Sometimes trades happen, sometimes they don't. 60-minute chart, it pulled back a little bit, as you can see, beginning of June, but didn't really go anywhere. So if you didn't get in, you didn't miss much. If you did get in, it barely pushed to the upside, didn't make it to the targets. So just be cautious. You may need to take your profits at break even. So another new opportunity coming up here is CTRA. And looking at CTRA, you can see we've been somewhat sideways. What I'm expecting perhaps is a pullback, and you can see if we pull back, this is below the kind of the range we've been in. So if we get a false breakout to the downside, you might be able to go long right around that 34 area. It's 33.83, 33.89 to 34.10. That would be your long opportunity with the rally-based rally demand targeting the eventual breakout to 37.92 and up to 40.28 for those two targets on the long. So that's what I'm expecting. We're kind of sideways. We get a false breakout to shake people out before we go higher. Buy the demand. Let's see. Whoops, sorry, hitting wrong buttons. FANG, Diamondback Energy, is another one I'm looking for. This is one of my 889 trade opportunities. In the E-mini think tank, I actually teach the 889 trading strategy. It's a strategy I developed about 15, 16 years ago and have been using it for quite some time. So if we pull back into this area of demand, we have a rally-based rally demand zone I want to buy around 145.07 to 147.43. This being the 4-hour time frame, and extensions give us targets of 167.32 and 179.62 to the upside. Moving on to another sector. That's weird. It didn't. Oops. Hang on. Kind of covered this up, I guess. You can see that the overall healthcare sector was pretty weak, except for diagnostics and research. And whoops, there it is. Just wanted to clean that up a little bit. You can see in that lower left-hand corner. So the healthcare sector, pretty darn weak. We had a nice retracement. It looks like we're impulsing to the downside again, possibly getting ready to tag the first target of 122.84. That's our first target to the downside. PRGO on the 4-hour chart was looking for a trade opportunity here on a pullback to an area of demand. Never happened. As you can see, we just kind of went around a little bit, pulled back just a little, but couldn't get into the demand zone. So this is what it looked like before when I was putting the initial trade opportunity. It has pulled back with a negative divergence. Notice the price made a higher high, the indicator made lower highs, and we still haven't hit the entry point yet. So watch this one for this week on the 4-hour time frame. PRGO looking to buy 37.69 to 38.72. Target 1 is about 41.17 with target 2 42.45. ACAD, Acadia Pharmaceuticals, another trade opportunity. This was originally, I think, for a long, but this looks short, actually. I don't know if I typed it in wrong. That should actually be a short, not a long. So let me change that. Make sure it's the right way. As you can see, it's an 889 opportunity again. I'm looking to short at a test of the 89 moving average along with supply at about 1886 to 1988. First target is the extension to the downside about 1564, and then second target 1352, third target 1022. Just try and take out those Fibonacci extensions. I want to be a little careful with this. I need some confirmation that's turning around because the momentum is very strong. So with the RSI above 60, I typically will not short at supply because supply is a lie. So I either need some sort of divergence where we make 2 tests of that zone, but the second test has a lower momentum indication. That would be a negative divergence. That would give me a trigger to go short. If I don't have that, I'm probably not going to take the trade. So just be a little patient with this. The consumer staples, or XLP, also a very weak index this week. If I go ahead and move this again, there you can see for this week, very, very red. So lots of selling pressure coming in. So looking for that to continue. Not sure if we're going to be able to rally up to 75.99, 76 area of supply, or if we're just going to break down from the basing that we're in right now. But I am seeing weakness coming into consumer staples, which if the markets are crashing, you'd expect that to go up, not down. Anyway, markets are acting a little weird. GO, or Grocery Outlet, was one of the defensive plays I was looking for a long opportunity, and prices never pulled back. So it's still potentially an opportunity to buy right around 36 if we can pull back into that demand. So you can see on the 4-hour chart, it really didn't go anywhere. Go, no pun intended. So if we can go down to our demand and bounce, I'll be looking for that buy opportunity still. BGS, or B&G Foods. This is a shorting opportunity with the weakness in that sector. Looking for it to rally up into 23.78, 24.12. Got a nice drop. Really, it's rally. No, I'm sorry, it is drop. Drop, base, drop right there at 23.78 to 24.12. Target number 1, 1956. Target 2, 1684. So looking for this to drop if we can rally into that supply. Hormel Foods, HRL, also looking for a short opportunity. We got a nice little supply zone here. Drop, base, drop. It would possibly be an 889. First test of that moving average since the crossover. And fresh supply zone, as you saw, we had that breakdown right here. So if we can rally back up, I'm looking for a short opportunity in the neighborhood of 48.05 to 48.49. And you can see the two targets here, 45.43, 43.81. So we actually did hit a Fibonacci extension on the way down. From the bigger time frame, you can see right there in the pink, it hit the 45.04. So if we rally back up, my targets are going to be 45.43 and 43.81, shorting at the 48 area. Finally, if we're taking a look at the big picture, I mentioned that you can use discretionary versus staples to get an idea of the overall market. And it looks like we're getting ready to resume our downtrend. You can see that the staples are outperforming the discretionary a little bit. We had that doji and indecision as we tried to break out to new highs. Had this sustained that move up and showed lots of bullishness, I would expect the markets to turn around and become bullish. However, what we see is a kind of a dragonfly doji, that topping tail there. And with that topping tail candle, if we confirm that by breaking the low of that candle this week, that would confirm that we're likely to continue to move down and see that the overall stock market will drop with it. So even the fundamental analysis here is showing us that we're pointing downwards rather than upwards for the markets. So looking at that on the weekly chart, it's still looking bearish. And if we can break the low of that candle, let's see what it is. We go out to my charts again and type in XLY, XLP, go to the weekly time frame. And that low, let me just clean this up, is 77.88. So basically this week, if we break 77.88 to the downside, that'll let us know that this bearish market is continuing, and look out below because there's not much to hold it up. So that's what I'm going to be looking for in the kind of fine-tuning the sector rotation here to see what's going on in the big picture. As far as what we're doing on the smaller time frame, the daily chart, we simply retraced 38.2%. So not a very strong retracement. Looks like we're going to continue to move to the downside. So that's going to be my analysis for this week, and I hope you enjoyed it. If you did, let me know. Make sure you hit the subscribe button and the like buttons. And don't forget, we're going to be moving on now into a recording of an interview I did earlier this week with an old friend of mine, a good friend of mine named Dan Sugar. Dan, as I mentioned in the intro, is a third-generation Chicago floor trader. He traded on the Chicago Mercantile Exchange, as did his father and his father's father. So without further ado, let's jump into it. Take a look. Here's Dan. I would like to welcome my guest. As you can see on the screen right now, we have Dan Sugar joining me today. Dan and I go way, way back, many years, known each other for quite a while. And we'll just kind of jump right into it, really. How'd you get involved in trading? How'd you get started? Tell us a little bit about yourself.
I was just thinking about that, Brandon. I will in a minute, but we met in OTA in Orlando in 08. So
oh yeah,
22, so like 14, going on 14 years or so. So
yeah, it has been a while.
Well, my start was actually it's a family affair. My father and grandfather were both floor traders. My grandfather started at what was called the Chicago Butter and Egg Board back in like 1900, 1905. Before there were soybeans and S&Ps and bonds, there was butter and eggs. So he traded butter and eggs. I'm the youngest, and my dad's the youngest, so I never met my grandfather. He passed about 3 or 4 years before I was born, and then my dad's the youngest of 5. So my dad started at the Board of Trade in 1950. He went to a couple years of University of Illinois, like a year and a half, 2 years. Didn't like college. Went to the Navy in Seattle, and then came back in January 1950 and got a job as a runner at the Board of Trade, and basically never looked back. 35 years there. So he got me my first job in the industry. I was 16, sophomore year, summer going into junior year. My friends were chasing cheerleaders and playing football, and I was getting up early, taking the train down to the Board of Trade. It actually was the Chicago Board Options Exchange. I was a runner for E.F. Hutton. Remember E.F. Hutton, Brandon? I'm sure you do, right?
Yeah.
Merrill Lynch was up here, and then E.F. Hutton was also big advisor and broker dealer and so forth. So my dad got me a job as a summer runner. I think I got paid $125 a week as a summer runner of about 8 to 3:30 or so on the CBOE, the Options Exchange. And I always joke with some students and friends, like my dad forced me to go in the industry, which is my brother went into journalism, so I told some students that my dad forced me to be but that's totally just joking around. But no, I just kind of exposed it to me, and after that summer, then I came back senior year, as a summer runner, and then after college or during college summers. as a broker's assistant, trade checker, learn the business from the ground up, basically. And then finally, after college, traded on the floor in the bond pit from 88 to 96. So about 8 years. And
Oh,
then,
wow.
I kind of saw the writing on the wall with electronic trading starting. I left in March of 96. And, Globex didn't really get to start going until like 99 or 2000, really good. But it just seemed like the volume was migrating from the floor to the screen. And I wanted to get a head start on screen-based trading. So I left in March of 96 and then actually was a futures and options broker licensed for 10 years.
Hmm.
That's my introduction. I'm sticking with it.
Okay. Was it hard kind of shifting from being on the floor to being behind screens? And
Yeah, I mean, to a certain extent, as you know, like trading is trading, right? But the process of, 6 bid for 200 or I'll sell 3 at 3 or whatever, the open outcry model is a lot different than analyzing charts in front of a screen or a couple monitors. So the process was definitely different. In the pit, you're trying to read order flow and get the edge from brokers, 1 tick edge, 2 tick edge, whatever, and you're scalping for the most part, which is just really short-term oriented, as you know, and your listeners probably are aware. But from the screen is definitely different. You're mapping out trades, trying to use some technical analysis, price action, volume, some indicators, maybe whatever. And so it's the process was different. So in my little ebook I just wrote recently, we'll get to that in a little bit later, but I mentioned that like looking back with the benefit of hindsight, it really was a great segue to learn how to trade from the screen. With OPM, I guess you should say. I was a broker, so I was getting commissions, but I learned from 96 to 05. I was a retail broker for 10 years. So yeah, that was a good process in learning, and definitely had to relearn a few things because the screen is definitely different, the process.
sure, absolutely. So, I mean, was it when you say you're learning, was there someone that you latched onto? Did you have a mentor that you were working with? I mean, how'd you end up learning to trade?
On the floor, I did. I mean, first and foremost, I think I was 9 or 10 or 11 when I first heard, cut your losses, let your winners run at the dinner table with my father, Justin. So he was a good mentor. He helped me along the way, of course. And then I gravitated to a couple floor traders that were clearing their trades through the same firm that I was. So I'd see them up in the office, at lunch or breakfast or taking breaks. So a couple guys were really helpful and took me underneath their wing a little bit and helped me in the bond pit. And then after the bond pit, from the screen, I met a hedge fund manager, a single owner hedge fund gentleman. He worked for Morgan Stanley he worked for JP Morgan on the Forex desk, institutional side for 10 years, but he always dreamed about opening a hedge fund. So he opened up a hedge fund, a single owner hedge fund, in 1997 with $1 million, 400,000 of his own money and 600,000 of friends and family. Because as you know, if you don't have a track record, it's hard to attract institutional money. So he started $1 million hedge fund in 1997 and ran it to $1 billion net asset value in 10 years by '07. So he retired pretty much in his mid 40s, and he opened up a little trading floor, Forex proprietary trading situation in Boca, actually down here in Florida. And so that's why he was my big mentor and influence on trend lines and some psychology, risk management, position sizing. I mean, I had a lot of foundational information on trading, but he took it to the next level with, there's always somebody smarter, more successful. And I went into it with an open mind and learned a lot. I was there for 3 years, 2010 to 2013. And that's pretty much where I learned my strategy and honed it and all about trend lines. Yeah.
Great. So, I mean, you learned your strategy. What are you kind of applying it to? What do you trade mostly?
I mostly trade futures still. I'll do a couple options every quarter, so not a ton of options, but mostly futures. I'll do some intraday stuff on stock indexes, gold or oil. And then I've started to swing trade about 2.5 years ago, where I'll hold something in futures for maybe a day and a half or 3-4 days if I can catch a nice little signal on a higher time frame, like the daily or the 480 chart or the 240. So mostly futures. I do some of the indexes because I'm watching E-mini, S&P, and NASDAQ all day long, every day. So I will do some of the leveraged, double and triple and inverse ETFs on QQQs and S&P as well. As long as I'm watching ES so much, if I see a pretty reliable, good signal I feel good about, I'll do some index ETFs as well. So,
Okay. So speaking of signals, yeah, no, you're doing education as well as trading. You're not just a trader, but you're sharing a lot of your knowledge. What is it that you're doing?
Yeah, I've been educating and mentoring as well, like yourself, for since late '07, '08, and then I went on my own March of 2020, smack dab in the beginning of the pandemic. I don't know if it's a good thing or a bad thing, but it happened the way it did. But so March 1st, so I'm going on about 2.5 years. Yeah, I got a class. I have a swing trading group. I have private consulting, and then I just wrote the ebook, and I actually just finished today. You know, some people aren't ready for the 4-day class with the price point or whatever. So I created a little 1-day micro mini class, two 90-minute sessions, introduction to trend lines, trend following, and trends. And so that's going to be a much lower price point at like $375 for two 90-minute sessions. And so, yeah, I really enjoy it. I get to share my knowledge. I've had some great mentors and coaches growing up and so forth. And I'm getting to pay it forward or give it back, whichever way I want to look for it, forward or back. But it's a great thing, and I've always told students, Brandon, that I derive a tremendous amount of professional satisfaction from getting to share my knowledge and help people become successful. It's not, as you used to say, trading is simple. It's just not easy, right?
Sure, absolutely, yeah.
Actually, it's a good segue. I'd like to show my little pyramid to profits. If I can share my screen.
Yeah, absolutely. I was going to ask you about that if you want to share some of that with us, because I'm sure everybody would love to see it.
Thanks. I've made this little document. Can you see the pyramid of profits?
Yeah, I do. That's great. Yeah.
Okay. So yeah, I came up with this years ago, and I just made a little pyramid. It's funny because they all begin with P. So I call this like my little 8-legged table. And you have to have all these in line to be successful, in my opinion. It starts with a process, the foundation. You have to have some kind of process, whether it's at night or in the morning or around your schedule. Everyone's busy, of course, but you have to have a process. We want to be process-oriented traders, not, seat of the pants type of emotional reaction traders. So process kind of segues into preparation. You got to be prepared. You can't just fire up your platform at 9:15 Eastern and start rocking and rolling with the E-minis, whatever, or any kind of market. So preparation is important, and then patience. Patience is twofold. Being patient to wait for your proper setups, whether that's a Fibonacci or a MACD or RSI or whatever you're using. Just wait for your setups. It's okay if you don't have a trade on for a half hour or 2 hours or 3 days. If you're a swing trader, it's okay not to have a trade or a position on. So patience to wait for your setups, low risk, high probability, above average reward. And then once you're in a trade, the other part of patience is super important, is letting those winners run. You're going to have some small losses, some small gains, some medium gains. But if you can knock out, 3, 4, 5, 6, 8, or 10 medium to big winners, throughout the month, many times that makes your month. So patience is twofold. Of course, psychology, 90% of trading is 85% mental type of thing.
Yeah, right? Absolutely.
So you got to have a mindset. If you're making decisions based off fear and greed, you're probably not going to do too well. And I'm sure you're educated and educated listeners that have traded live money before can relate to that, easily. So psychology, super important. Proper mindset. The edge starts in your head, right? And then successful trading is all about probabilities, right? You got to think of it as probability theory. And if you're a good 7-card Texas, black or poker player or a blackjack player, it's very similar. I mean, trading is not gambling, but there are parallels and correlations. So you got to think of it in terms of probabilities, right? Don't have that, what they call it, the outcome bias. Like so many people think that this current trade they're in has to be the big winner. It's got to be the big winner. And if you look back and take a step back, it's just one trade of several trades you're going to be in that day or that week. So probabilities, and then position sizing is obviously very, very important. Don't trade too large. Even if you got a 50K futures account, don't start trading 4 or 5 big ESs. Start with the micros or one ES, whatever, and build up. After a month of making money, you've earned the right to increase your size a little bit. But I got burned at least 3 times over my long career with position sizing, and finally 3 strikes and you're out. So that's a big one for me.
I like what you said there real quick about the earn the right to go to bigger size. You really have to kind of prove your worth, if you will, to show that you're mature enough to handle that. And then psychologically, as you go, through building that pyramid too. psychology was huge on it. And I love the way you just said that you have to earn the right to
Right.
trade the bigger size.
Some people might do it, 1 month of making money. Some people might wait a quarter, whatever it is. But I met guys on the floor, Brandon, that were great traders at, 1, 2, and 3 lots in the bonds. And then, a year, 18 months later, they're shooting 5 and 10 lots. And then 6 months later, you didn't see them anymore. So some people, couldn't handle the incremental position sizing. And either they went back to what was successful, or they blew out their account and never came back. So, size matters in trading huge, and size matters in trading is a big thing. I don't want to use huge as you don't want to trade huge, right?
Right.
But what they say, trade small, grow tall. Trade small, grow tall. I mean, if you're a futures trader with a 10 grand account, you can make $1,000 in a month with 1 lots or 3 or 4 micros now. And there's no excuse, because now all the liquid markets have those micro contracts, oil, gold, S&P, et cetera. So start small and earn your right to trade another contract or another 2 micros, whatever the case may be. But yeah. And then the last couple were patterns. I'm really big on 5 reliable patterns. Bull and bear flags are super reliable. They don't all work. Nothing does, but I found them to be very reliable. I'll even show you later. There's a beautiful bull flag on S&P today, actually. So bull and bear flags, ascending and descending triangles, and then a simple wedge or symmetrical triangle. They're interchangeably called wedge or symmetrical triangle. Those 5 patterns, again, they don't all make money, but a lot of them are very good high probability setups, especially on the intermediate or higher time frames. And then those first, they all lead to performance, right? Trading's a very performance-based sport or performance-based endeavor. You know how you did every day, every week, every month, and then performance leads to profits. So there's my little pyramid of profits. Actually, let me throw the link, and I got a little bit.ly link, and so anybody on the podcast would like to grab that for free.
Yeah, that'd be great.
Let me put that in there real quick. There we go. Copy and paste. There we go. Yeah, so if anybody wants to print that out, it's a nice little PNG or PDF file, and they can do that.
Yeah, so you got the trendlinebreak.com there too for your website as well.
Yeah, that's the website.
Yeah, the link. Yeah. Still there with me? Hopefully I didn't lose you.
It came through good, right?
Okay, there we go. You were frozen for a second. Oh, there we go. Now I can see your screen with your trading platform. I didn't get the link though.
Did the link come through the chat?
Oh, did you put it in the chat? Okay, I
didn't see it in the chat.
Oh, I'm sorry, my bad. There we go. Okay, so I got the bit.ly. Okay, there we go.
Yeah.
All right, yeah, so it did come through the chat, and I just clicked it on myself, so I'll go ahead and put a link in the text as well. So I'll put that in the commentary for the video as well if it doesn't come through on the chat for some reason.
Right,
so
thank you.
Yeah,
Brandon.
no problem. Got it. Awesome. Yeah, I got that. Okay. Yeah, you were talking about some flags or something. I don't know if you want to show us some of the stuff that you've been looking at on the markets since you got your charts up there now. I'm not sure if my internet's bad or yours, but I keep
volume chart.
Yeah. Oh, sorry.
I'm sorry, what?
I'm cutting in and out. I'm not sure if it's me or you cutting in and out. I apologize, but
can you see my 10,000 volume chart on the ES?
Yes, I see that.
So earlier today, we had a nice little sell-off and then a phenomenal double bottom. Yesterday's low was like 71.50. Today's low was 72.25 within 3 ticks. And if I can just remind your viewers, but one of the things I learned on the floor of the exchange was, price has memory, and double tops are very tradable. Double bottoms are very tradable. Again, they don't all work, but a lot of them do, and they're low risk. You know where you're wrong, and sometimes you catch a nice turning point. And today's a great example. Today's low was 3 ticks above yesterday's low. We opened strong, sold off hard from 41.08 to 40.72, and then took back off. And here's the bull flag. So, a lot of people don't want to buy high and sell higher. They want to buy low. But when you get a reliable pattern, here's your flag. Here's your pull. just impulsive move. Then you go sideways to a little bit lower. And then the quicker you can recognize it, some flags have only 3 or 4 candles inside of it. Some have as much as 8 or 10 or 12, but you want to get long above the breakout to the upside. And it's just a rally-based rally or a continuation pattern. And a lot of times you can do that measured move, which as a CMT, I'm sure you're well full aware of, Brandon, the measured move. You just take, 72, the low, to the top peak right here, 41.22. That's 50 points. You add 50 points to the breakout. Does it always go there? Of course not. Sometimes it gets close. Sometimes it goes right to the tick or two, and other times it goes past it. But it gives you a little range of where you might want to take some profit. So you add 50 to the breakout at 41.17 or so, and sure enough, today's high is 41.60. So that's a great bull flag today. Rally-based rally breakout. And look at, one of my taglines was, NDM, never down money. With these patterns, Brandon, and trend line breaks, sometimes you take a little heat and it goes, let's say you got a $300 stop on it. You're up 150, you're down 200, you're up 200, then you're down 250. You got a $300 stop. So you got within $50 your stop, and then 20 minutes later, it goes your way. Great. So you took a little heat, as we say, but other trades like this one, never down money. You know what I mean? Like this trade never went against you.
Right.
You got long at 16 or 17, it went to 36 quickly without a retracement. That's, over 20 points. And in the time frame was, this is a volume chart, 10,000 volume chart. So the time was 11:38, and then it peaked. The first peak was 11:52. So 14 minutes. Then you have a little pullback. But then if you had some patience, letting those winners run, look at that beautiful bull flag.
That's the key thing, is having the patience to let it run. You got to have some sort of a system that makes sure you just stick with the trade and let those winners just grow on its own. They'll do it.
Absolutely. Like, here's a scenario. I love putting in, mental models or real life situations. Like, let's say your last 3 trades today were small losses and you're down $600 or $800. And then, you get 1,000 back and you're super happy and you grab those profits. But with a little bit of patience, it could have been $2,000 or $2,500. You know what I mean? So We've all been there. But like you said, if you have an exit strategy, an exit plan to help you, I love scaling out. So if you put on 6 micros, take off 2 or 3 at a nice 3-to-1 profit or whatever your target is, and then let the other 2 or 3 run and just move your stop up. And if you catch a trending move, great. If you get stopped out on a little pullback, okay, you still made some money, but you have to have that in your plan. So you're not trading from greed or fear standpoint. You're trading from a power of strength when you're sticking to your plan.
Absolutely. Yeah. That's awesome.
Yeah. Love those flags.
Yeah, like you said, there's a bunch of different patterns that you follow. As long as you have the high probability in your system for following it, you should be on the right side of the markets more often than not. And that's what the key is right there. As you said, probability is one of your P's that you had in the pyramid.
Right.
It all comes back to that.
Sometimes a bull flag will break out and you might get a 2-to-1 or 3-to-1 trade. Then it comes back to right near the breakout area. And then the second wave is the 5-to-1 or 6-to-1 winner. So you just never know. Sometimes the first one's the big 5 or 6-to-1 trending move. Other times it doesn't work at all. And then the third time you might make 2-to-1 or 3-to-1. It comes back to break even. And then the second leg up or the second wave is really powerful.
All right. So you got to have the strategy, like I said, to keep yourself in the trade rather than get scared down trading on emotion. So it's all about that, looking for the high probability, the pattern, and following through with your high probabilities.
Right. Yeah. And one more thing regarding that, as long as you're position sized properly, right, you shouldn't be nervous or fear or greed. You have your 4 micros on, or 1 micro, or whatever your position size is. If you're risking 1% of your account or 1.5% of your account or up to 2% of your account on every trade, then from a risk standpoint, every trade's the same, right? Every trade's the exact same. If you got a 10 grand account and you're risking 2%, every trade is about $200 of risk. And so you treat them all the same. And, one might be in gold, one might be in oil, one might be in mini Dow or whatever. But from a risk standpoint, we're all the same. You want to be like a robot with that attitude that way. Yeah.
Yeah, absolutely. Okay. One other thing I wanted to bring up is something else that you just recently did. I know that you were kind of raving about. You created an ebook, I guess it was.
I did. Throughout the years, a bunch of students used to say, Dan, you should write an ebook. You got all these whatever and all this knowledge. And so finally, I got the time and energy to do it. So I put it together in about 2 weeks, and then put in a little ebook. It's about 5,000 words, 20 pages. It's called Trends, Trend Following, and Trend Lines. Let me put the link on that one.
Yeah, please. Are you going to put it in the chat, or are you losing you there for a second?
Because I did it, but it's got some great information and so forth. Let me pull up.
Okay. Sorry, I keep getting you cut off every time you go to bring something up here real quick. So what I also did while you're waiting for that, let me go ahead and
Here we go.
You have it? Okay. I was going to say I can bring up
Yeah.
the bit.ly.
Yeah, here we go. So that's a little cover page
there
my tech guy made for me. But yeah, it's a PDF, and it's got a lot of really good information. Again, how to locate the macro trend. I think trends are on two parallels or time frames. Macro trend, big picture, daily, weekly, monthly. Then you got the micro trend for a couple hours or a couple days. So you can locate the macro trend, and I think people make it much more difficult than it needs to be. You're just looking for higher highs and higher lows, higher swing highs, higher swing lows, or some people call them pivots. And then I take it a step further and draw the trend line. Right? It's
Sure.
Technical analysis is so visual that you can see them on the charts clean, and so you identify the macro trend. And one of the older strategies in the book, going back to Edwards and McGee, if the trend is up, buy pullbacks and retracements to good support or demand zones or the uptrend line. If the market's in a bear market or downtrend, you want to short the rallies into supply or downtrend lines or resistance. And trending markets offer the best opportunities. So one thing I think your listeners can benefit from is identify the trend first and foremost. Are we having higher highs and higher lows? Are we in a trading range, relatively equal highs and lows? Or are we in a downtrend with lower highs and lower lows? Because you're going to trade and approach each of those three scenarios differently. So in an uptrend, you got to look to buy pullbacks and get long. Trust the trend. It's trends tend to perpetuate, and trends are powerful. If the market's in a trading range, then trade that range for a couple of days or a couple of weeks, however long it trades in the range. And then if it's a downtrend, you got to be looking to trade from the short side. And since January 3rd, we are in a nice downtrend. We're having a nice monster rally today, but since January, pretty much every rally has been sold into. But if we can get above some of those higher time frame downtrend lines, then the bulls have a shot at coming back, and maybe we get a June or July summer rally potentially. But with the inflation headwinds and the FOMC telegraphing higher rates, and there's just a lot of headwinds that the bulls have to go through right now. So you got to keep an eye on the bond market. Watch the TLT, watch the T-bond futures or T-note futures, because one thing I think the listeners can benefit from as well, Brandon, is there's a couple correlations with stocks and bonds, right? When stocks are going up and they're getting 15, 20, 30% a year, there's no reason to own bonds that pay you 1 or 2%. So stocks up, bonds down, right? And then stocks down, bonds up, flight to quality many, many times. When stocks get hammered, there's a flight to quality many, many times. But when bonds start to drop hard and rates pop, then the stocks follow the bonds lower. So they're both going down together. So 2/3 of the time, it's the normal correlation, stocks up, bonds down. But then since January and maybe even late November, December, when bonds come down kind of quickly, if they break a daily or weekly trend line and they start heading down with no support for a while, rates spike up. The market doesn't like rapidly rising rates. And then the correlation is the same, where stocks down and bonds are down. So as traders, we need to be cognizant of which situation we're in. And lately we've been in bonds dropping and stocks dropping with rates spiking. So listeners definitely keep an eye on the bond market, either the TLT or 30-year bond futures or the 10-year note. Pick one of them and keep an eye on it, because we'll give you some clues on what's going on with the stock market.
Yeah, absolutely. I mean, they're offsetting cycles that they usually go through, and I've been watching those for years. I mean, we talk about looking though, they can even signal recessions as well, because you usually have, I think it was somewhere between 24 and 27 months from the bond market peak to the start of a recession on average. And then you had about, I think it was 12 to 18 months for the stock market peak to the start of the official recession. I mean, the recessions are always declared late anyway, but
right,
those cycles, and it seems like, as you were saying, yeah, we're in that later part of the cycle now where they're both starting to head to the downside. And that means, what we're looking for is the flight to safety pretty soon, if not here already. Yeah.
And again, I mean, we shouldn't be too shocked. We've had a 12-year bull market, right? From the
That's
market,
got to be time.
the market troughed in March of 2009. And the Fed's been, in a dovish stance. And, remember Marty Zweig years ago, don't fight the Fed. And it works in bull markets and bear markets. So a little 20-30%, pullback, retracement, bear market is kind of healthy as long as you catch it, right? And don't get your 401k. You don't have to turn into a 201k or a 301k. But NASDAQ's down about 30% from the peak to the recent trough. And then S&P is about 20 or 22 or so. But the big question is, are we going to have one of those, 45 or 50 or 60% drops in the QQQs, NASDAQ, or 40 or 50% drop in the S&P? That's the big question that investors and traders.
Yeah, we've only had, I think, about 20%. We just barely touched it on the S&P. We've had over 20% on the NASDAQ, but it then popped back up. So yeah, the big question is, the shoe going to drop, or was that the bottom, and are we going to have a soft landing type thing? So as you said, I mean, there's going to be signs.
Right. You were around the markets in 2000 and the dot-com bubble. The NASDAQ lost 85% in about 18 months. QQQs went from 120 to 20. 19 something was the intraday low. S&P and Dow got cut in half, 50% or so, but NASDAQ lost 80 or 85% from March of 2000 to the trough and whatever it was.
I think the intraday high was about 51.52 on the NASDAQ, and then it's just, because I remember it was 51.50 is California code, and it's also the Van Halen album. Right. So I remember that 51.52 was the intraday high, because we went a little bit past crazy on 51.50.
And then in 07 with the real estate.com bubble, NASDAQ lost a lot more, because technology is more of an alpha mover and sector than S&P and Dow. So, the tech, they dumped the tech stocks first. So watch the FANGs, the Facebook, Amazon, Netflix got crushed, as we saw. And, one of my other favorite sayings is, markets take the stairs up and the elevator down, and sometimes it's the express elevator, just because fear and greed situation, obviously. But yeah, so keep an eye on technology, and we'll see if the NASDAQ has more to go. And there's a lot of headwinds with inflation and rates going up, and we'll see. But it's going to be an interesting summer, or second half of. We're already in June, amazingly. So interesting second half of 2022.
Absolutely. So let me go ahead and share my screen again with you one more time. And I've got the links there along with the clicks. I clicked on the link. So the first link right there, the bit.ly, is the pyramid and the damn secret sauce, as you can see right here, the Pyramid to Profits 2.0 guide. And that's again, the first link there. The second link is your ebook, which I honestly have not read yet, but I'm going to go ahead and download and make sure I read it too, because I've always learned good stuff from you as well, knowing you for as long as I have. It still surprises me, and I get good information. I mean, that's one of the reasons why I teach too, is the interaction with people.
Yeah, there's in the ebook.
Yeah,
you got 4 specific strategies: 2 for bull markets and 2 for bear markets.
Oh, even better. Okay. Oh yeah, I see right here the 4 specific strategies.
Yeah,
that way you're kind of prepared for pretty much everything. That's great.
Exactly, and we are in the middle of a bear market. We'll see how much lower it has to go. Maybe we'll end it soon, but I think we're only in the 4th or 5th inning, personally, from what the charts are telling me. We've taken out some weekly and daily trend lines, and we'll see. But I just think there's a lot of headwinds, and again, bear markets. The average bear market's about 37%. There's some that are more, some that are less, but on average, with 120 years of data and about 7 to 9 months or so. So we'll see, but time will tell. But trend lines can really help you gauge those market reversals and market turns, in my humble opinion.
Yeah. And then I also put it in trendlinebreak.com. So those are the best ways to get a hold of you. So you got the downloads for the information there, as well as your website. I want to thank you for being here and spending a little bit of time with me, kind of sharing your background and stories and what you got going on. Thanks again for being here. Appreciate it.
Thanks, Brandon. Great to be with you. Time flies, so we were having fun, but thanks again for looking forward to doing it in the future.
Absolutely.
Thanks.
All right, cool. So